Okay, we're back to trying to do the following, and that is help you through some of the questions where the test bank that I was able to mail out had some of the numbers missing, and this is another one. I don't think there's too many more, but you can email me if there's any that I'm missing, or if there's any other problems you want me to go over. I'll send that in an email as well. So number 71 was similar to that, and let's see what we have here. And this particular question may be beyond the scope of what I would even dream of asking you, but if we can follow along and you can understand the results of the question, you'll be far better off in answering other questions, because again, this is going to get back where we're using my economics approach to the deal. And I think one of the unusual aspects of this, I want to just make one more comment, one of the unusual aspects that may be troublesome to accountants doing this is we're not, as much as the economy drives everything in the world, and as much as it really is the bottom line of whether you're wealthier or not based on the economics of, quote, business transactions, we as accountants are not quite attuned to economics because of our profession. We're more historians. We're reporting what happened, and we're not necessarily looking at fair values all the time, or even recognizing fair values. As you know, U.S. GAAP, oftentimes ignores fair value in transactions. But in this partnership realm, which makes it perhaps more difficult than any other accounting, is that it doesn't ignore it. And that's, I think, where this issue with tax and economics gets confusing. At any rate, that was my comment. Let's go to the problem. All right, the fair market value of cash, of course, you now know it. Cash is king. It is what it is. 10,000. The receivables in this problem, what you couldn't read was the fair market value of the receivables is 10. The land, you couldn't read that, and that was there's no land, so it's just $20,000. That's the total of the assets in this PW partnership. And what the problem tells you is that it distributes to Pamela, and this is a equal 50-50 P and W, and they're 50-50. And so they're going to distribute to Pamela cash and the unrealized receivables to Wade. Now, economically, that's fair, because the value of the receivables is exactly the same as it is for the cash. So Pamela agrees to it. Wade agrees to it. It's fine. In this case, though, they each have an outside basis, as it tells us here, equal to 5. So that's where we start getting into, all right, well, how does this affect them tax-wise? We have to keep in mind the economics and the tax part of it. So their outside basis for tax purposes is $5,000, and the problem's asking us about Pamela, what happens to her, and what did she receive? She got the cash, so she clearly has a $10,000 cash to her. Let's do it this way so it's clear. Pardon me a minute. She's getting, let's look at the economics. She's getting $10,000 cash, and she's got a basis of 5. So clearly, her gain is $5,000. There's no question about that. She's got a gain of $5,000. They've ended the partnership, so we do have to recognize gain. This is definitely, and there's no liabilities. And why I say it ends this partnership, because it does tell us it's in complete liquidation. So this is not a partial liquidation or not an operating. This is not an operating distribution. That's the differential. So she gets $10,000 of cash. She's pretty happy about that, and Wade shouldn't be unhappy either, because the value of what he gets is equal. It just happens to be in uncollected AR at the time, but presumably he's going to collect it all, and his gain will also be $5,000 because he has a basis of 5. So now you can start to see some of the issue here. The part of the issue is that where is the gain involved here? Look inside. Take a look this way. Take a look inside here. Where's the gain? The gain is on the fact that there is $10,000 of receivables that haven't been recognized for tax purposes. The taxes haven't been paid. It has a basis zero because it hasn't been picked up on a tax return yet. It's cash basis. That's obviously what's going on. In order to have a inside basis of zero, must be cash basis. Otherwise, accrual basis would give it an inside basis of 10. We've seen that before. So this 5,000 here and 5,000 here represents the $10,000 of unrealized receivables that we haven't paid tax on yet. That's where the gain is. There's no gain on the cash. The only other this is a great example because it's so easy and clear to see exactly what's going on here. And the tax rate, the type of income that the receivables mean, since it's one of those hot assets, is ordinary income. So really what we have is ordinary income embedded inside this partnership that's being split up in complete liquidation. But the problem is that Pamela's getting cash, and that would look like it is pure capital gain. If you were to say that, if you were to say she gets capital gain, then you got to look over here and say, well, he's getting the receivable, so that's a hot asset, must be ordinary. But wait a minute. The total, this is why it's such a great problem, because you can see it so clearly. The total ordinary income is $5K, and then capital gain is $5K. Well, all right, it adds up to the total gain on the receivables, which is 10. See that? The total gain is on the receivable side, but it doesn't add up to both ordinary income. All we have is, we've got a split here, capital gain and ordinary income. Again, we have a total of 2 pieces of gain, add up to $10,000. Why is there any gain on the distribution here? Because their basis is the cash. Both of their basis adds up to the cash. The cash is the cash. If all they had was the cash to give out, $10,000, there'd be no gain or loss to anybody. But the reason why there's a gain is because they're each getting a value of 10,000, because inside was a value of 20, and the reason for the fact that there was this 20 value versus the $10,000 of their combined capital accounts is because the receivables haven't been recognized for tax purposes. It's exactly that. So if you were to do hers at capital gain here, let's go back to highlighting it this way, and Wade's at ordinary income, this is Wade over here, and this is Pamela. If you were to do that, then you're picking up the right amount of gain, but you're missing the ordinary income aspect, because all of the gain is really ordinary income. All of it is ordinary. It's all based on the hot asset. So that means that you can't do this. That would not be fair tax-wise, and it's not fair to Pamela either, because she's going to pay, well, it's not fair to Wade, because Wade's going to pay ordinary income tax rates. That's what I meant. It's not fair to Wade. So the result is that both parties have to pick this up as ordinary income in order to be fair about it, because that's really what it amounts to. That's why it's a great problem, because it's so easy to see. And that is one of the answers, and that is the answer, answer C. She picks up ordinary income. I hope you follow that. It's a great, great problem to illustrate how this works. If you follow the economics of the deal to the tax law, it's hard to make a mistake. It's hard to make a mistake. Okay, that's enough for now. We'll pick up another one in a little bit.